The retirement dream. Such a beautiful idea that all of us were sold to, where you would have steady income because of your prudent savings and investments and social security programs and employee sponsored plans to help you retire into a luxurious suburban life while you travel the world with many vacations and you're all smiling with Kodak Polaroids for your family pictures. Yeah, none of that exists anymore, by the way, right? Our millennial generations, there'll be millions of us without a retirement plan. And why is that? Why is the retirement dream now a retirement nightmare? Why is it that governments around the world are pushing for later stage retirement ages? Why is it that the dream that did so well for the previous generation is actually a nightmare for today, the millennial, and the generations right after? You've reached the Financial Almanac. I'm Basil. Let's find out why, what happened, and how we can plan and save ourselves from the retirement scandal. There was a time when, the millennial generation, we're growing up and we're listening to people talk about defined contribution and defined benefit plans and your employer sponsored programs, and make sure you save and invest for your retirement. And if by all fail, contribute to your security systems that your government will support you in. They'll deduct certain amounts from your paycheck and everything will be rosy. Well, guess what? That pension that the government was controlling, whether it's old age security or your social system in your area, they draw down on it and didn't tell us. They told us that, hey, here's an IOU. I'm just gonna borrow some of your pension money, your retirement money over here in your social security system. And here's a piece of paper saying I owe you this much. And we're just gonna take this and spend it elsewhere because that's what we campaigned during our election. And that's where we spent it. And oh, by the way, the return never really came back as we thought they would yield. And so we're gonna figure out how we can pay you back because the investment went bust. And that happened all across the board. Name a country, name a state, name a province. Yeah, highly underfunded capital is at all of these pensions. So what are we to do? Just save and invest? Well, that's being inflated away. At best now, 5%? That they're saying CPI, it reached 9%. And that's just year over year, not including the previous years, which grown exponentially, and then that grows exponentially. And now we're talking about there might be a mild to severe recession that might compare to the Great Depression because of a huge market correction. What if the S&P, 500, comes back down to 2,200 or 2,000? That's a 50% drop from today. What are you going to do with your pensions? What are you going to do about your regular investments? What if there is a commercial real estate crisis and a lot of pensions have commercial real estate in them, right? A lot of, pension plans are owned by managers that allocate because of REITs, real estate income trusts that say, oh, commercial real estate's, they're businesses that have generated income for this many times. Look at the history. And COVID happened and people were working from home. Commercial real estate, especially the office sector, decimated. And that hasn't showed up yet in our charts. That is going to show up as unemployment rises. Inflation is going to be battled quite well because of that. But guess what? All that inflation that took place, you think the equivalent took place in your portfolio? No, it did not. Today, we know that the middle class is slowly evaporating from the haves and the have-nots. Right? Slowly being decimated, and this is nothing new. This has been happening for a while now, right? We all know this. But not only that, they're asking us to retire later because of this poor management system of the pension system, the social system that we're experiencing today. Okay, we'll retire later under duress, all right? We've been coerced under duress, but we'll have to do it. We have no other option, all right? And the middle class is being deteriorated, so there'll be more of us competing in that system. Right? Not only that, if the security social system that's in place today in Canada or in the States or in the UK or Commonwealth countries, guess what? If we were to take a snapshot and look at the millennials, just the millennials, not assuming the baby boomers draw down on these accounts, just the millennials alone, right, that have contributed for over almost 20 years now, right? Assuming they're 38, they started investing definitely a lot earlier, but let's just say 18 to 38, right? For those 20 years, we've been investing in all these security programs that have been automatically deducted from our paychecks. We would be able to withdraw on a regular basis $3,600 a year, not a month. On a regular yearly basis of $3,600 a year from what exists today, before everything is hyperinflated in our economy. How is that possible? We need a minimum, estimates are saying, $60,000 for basic needs per year. 60,000 versus 3,600, that's almost 20 times. Where are we going to make up that difference? 60,000 basically covers, roof and shelter, right? Utilities to get that up and running, right? Showering, cleaning, dishes, all that stuff. On top of that, not only hygiene, but also traveling, food, groceries. That's going to be wild in the future, especially if you want to eat healthy and nothing is GMO based. We think 60,000 is going to cut it. And that's one source of income. That's not even household. Your partner will also probably have to work. As soon as your child's able to work, they'll probably give them a pickaxe too, I'm joking. But you know what I mean? The economy is so heavily underfunded, and it's not underfunded by a reason. We did a good job. We've invested the millennials for a minimum 20 years, right, into this system. So what happened? What about the baby boomers? What happened to their contributions? I feel really bad for them because they've been duped too. This is what happened. That security social system, that pension system that exists today that all of us have contributed into was withdrawn. We have politicians that allowed non-elected officials to come in and take some money to spend it out there, in some infrastructure or some, greasing lobbyist movements. Who knows? These guys are all keeping it in the black books. They won't tell you. But what they will tell you is, oh, we still owe you that, so here's an IOU. It's not currency. It's not cash. It's not money. It's not gold or silver. It's an IOU on a piece of paper, a sticky note. I owe you $20 trillion. No problem. I'll get to that one day, but right now I just need that money to pay for this because we're campaigning. We want to make sure we get voter rights, and we need to keep up something else on, the budget. When is that going to be paid off? Oh, it's not going to be paid off because it's such a drastic amount they draw it down from. They saw it as a cookie jar and they just went in with their hand and said, thank you. Oh, here's an IOU. We'll take care of that later. Maybe not in my administration, maybe in the next administration or the administration after that. Somebody else will come and make sure you guys are okay. And if everything else goes wrong, we'll just print it. We'll print money, increase the circulation of money, diluting your savings, your investment out there, increasing the production costs of everything else, hence inflation. But at least we printed $20 trillion, even though the economy had to experience $200 trillion in order for that $20 trillion. You think that $20 trillion has the same purchasing power? That should be adjusted for purchasing power. If you're really upset, make sure that they adjust everything to purchasing power, not interest rate. I just want to break even. I'm not even trying to invest anymore. Let's break even according to purchasing power. And not the, CPI trick where, because you can't afford steak anymore, we'll remove that from the formula because you're only buying ground beef, so we'll put that in the formula. No, we used to have the standard of living, right, in courts, right? When a divorced person, when they're in court and divorcing, they say, I had the standard of living, so they have to pay me this much. Well, guess what? The government doesn't do that. The government says, because you had steak dinners, but you no longer afford it in your CPI, and now you can only eat ground beef, we're not going to look at that because you're only purchasing with money you have today, that even though everything else got more expensive, including the ground beef, that's what you can afford today. That's what we'll look at. They need to maintain the purchasing power that they borrowed on the day they took it out and put the IOU slip, or else what's the whole purpose? Everything will be fugazied, inflated away. And we're holding the bag, the people, because we're not holding these guys responsible. They are more worried about their political and career progression and around their friends, having laughs, having expenditures that we should really not be considering because they're doing such a bad job. We should pass a bill that says if you perform at X amount, or if it's over budget by this amount, you can no longer run for the next administration. That will clean up their act so fast, it'll be ridiculous. In democratic countries, pension systems are in shambles. More than ever, people are struggling paycheck to paycheck, many of us. Not only that, and the pensions have been drawn down severely, you have to be filthy rich today to not even worry about retirement. That's not most people. Most people are worried not about them also, but also people that they love, their parents. What's going to happen for the next generation as we kick the can down the road? This is something on the forefront of all of us. And no matter what country, what state, what province, wherever you are, this is happening around the globe. Look at France. Look at the protests with France because they went from 62 to 64. We need to start holding people responsible that we entrust to preserve our purchasing power. That is the key. Even though the cost of living is the biggest threat to our financial security, many of us have dreamed about having a cozy retirement. Nothing too crazy, nothing too lavish. Just what we expected, the maintenance of our lifestyle. Quality of life is still there. Have a retirement in our mid-60s, spending time with loved ones, being able to travel, and being able to pursue our hobbies and our interests. Was that too much to ask? Apparently it was, because they didn't care about that. They said, hey, we needed money, and you guys will hold the bag. Even though that many of us have different dreams for our retirement, it is imperative to have a fallback cushion of financial stability. Even though many of us in the middle class wanted this, that is no longer a possibility if things keep going the way they are to fall back on. There'll be nothing if we just sit idly away, hoping and trusting that the institutions we really believed in did not misbehave and misallocate our funds. And now we have to do more adulting than ever. Nobody likes doing more adulting, right? Now we have to do that twice as much in order to preserve our financial security and our peace of mind. It is getting ever more harder day by day as day passes by to attain this dream of retirement. And if it's not just harder, for many people, it's downright impossible. But retirement is on everyone's mind. How is it achievable now? When people go to work, it's directly in front of their face. They're building towards their retirement. When they get paid, they know they've had that deduction taken away so they can retire. We literally have it ingrained on the fabric of our society, day in, day out. And yet, somehow, it slipped between our fingers like sands of time because of mismanagement. Now, I know all of us have worked so hard, or at least have contemplated on how we will achieve this retirement goal that we all share in common. And with the ever more risks that exist today, we have to take on more risks in order to compensate for that diluted, inflated production that we have in our system today. Sadly, the reality is there's a huge disconnect between what we were planning and what actually is. Short of gambling at the casino or buying the Powerball or investing into Pepe coin or Dogecoin or a financial miracle to stabilize our economy, what is the middle class supposed to do to achieve these realistic goals that we worked very hard in trying to pursue? In today's financial economy, right? 67% of us that are walking around, our neighbors down the street while we're shopping, people that we know and love, 60% of our population in our country is actually very worried about retiring either today or soon or in the next few years. That's not including the people that are in their 30s, and 40s. We're talking people that are at retirement either today or in the near future. They were sold a belief back in the 1940s that your family will be able to reliably live if they invested into their retirement. Using, the three pillars that we touched on. Your savings, invest in your retirement, they said. Your social security, right? The government will take some contributions from your check. That way we can help you live better in your golden years. And lastly, your employment benefit. We'll contribute to this. We'll give you this benefit. We'll match that. Those three pillars, right? Was the stool that was needed to have a great golden year era while you were enjoying it. But after the financial crisis of 2000, that changed drastically. Now, all of these pillars, these three pillars, were severely weakened. And now more than ever, large majority of us, 60%, 67%, roughly speaking, are more worried about retiring soon or at retirement. That's not including the next generation, my generation, the millennials, or Generation Z, or anyone after us, on how they will retire. Things are not only destabilized for those that have lived during the 40s, right? And were promised this era of golden year and retirement. That has all changed. From 2000 to today, how many events took place that were considered crises, right? We had what we just went through, C-19 pandemic. We had 2018. We had the events of 2008. And there's ones sprinkled around here and there, right? So there's all these events that weakened either your savings, your defined contribution from your employers, including their stock price, right, their ticket, and the social security system in your region. All of these were financially, purchase power have evaporated, right? They've been severely weakened. Yet in the social security trust funds today, the officials that are, overwatching that and managing it, and all these guys, all these officials are acting like nothing happened. Like everything's okay, everything's la-li-da. There's a report released by the National Institution on Retirement Security, and they estimate that by 2030, the pension funds, right, will be completely depleted. Ladies and gentlemen, that's less than 7 years from today. That is 6.5 years from today. By 2030, the National Institution on Retirement Security believes that the pension system by our government, federally regulated, provincially regulated, state regulated, will be drawn down. All these decades that we've invested will be gone. If that doesn't boil your blood, I don't know what would. But not only that, the private sector employers are finding it harder and harder to find contributions and benefit for their pensions. The public sector employees that have contributed and benefits from their retirement, those accounts, those investments are performing terribly today. And unless their account managers, one out of how many, is doing a decent job by expecting the crash that's going to happen with the commercial real estate and have not invested in REITs and real estate investment trusts, if they have not withdrawn and allocated accordingly, if they kept most pensions as the way they are today, as they were for the last couple decades, where thinking that real estate is secured with commercial real estate because people are businesses and they're paying their incomes on time, the commercial real estate sector is about to get a huge correction. Offices are completely empty. The industrialized sector of commercial real estate has been heavily with just huge amounts of layoffs. The recession hasn't even started yet, technically speaking, but we're already seeing it take place. What are people to do? It's on you now. You and me, we have to put our minds together and come up with a plan that you will be secure in the future. But that system that we grew up on, thinking that the collective system of all of us contributing to our retirement and collectively withdrawing was going to work, is no longer the reality. The world has completely changed. Now it's up to you. Now it went from the collective to the personal. The same agency, right, the NIRS, the National Institution on Retirement Security, has also shown that the median age between 55 and 64 currently has a balance of 0 when it comes to retirement. 0. Don't shoot the messenger. I'm sorry, a lot of you guys probably already know this that are watching. Not only that, the upper middle class, not the upper class, just the upper middle class right now, if they are successful in their endeavors, have a savings of only $88,000 for their retirement. $88,000 is 1 year. And that's assuming that you're drawing down on that $88,000 right away. In a retirement plan, you have to take incremental withdrawals or it'll affect your tax bracket. So that basically means that $88,000, if allocated, and spread out accordingly in 30 years, that'll give you $3,600 a year. We need 20 times more in order to sustain our current lifestyle at a target of $75,000. Where are we going to get that 20x from? If you expect to live a long, healthy lifestyle into your retirement years, your golden years, the Trans-American Center for Retirement Studies has shared that as of this year, 2023, 69% of the population that is retiring expect their primary source of income for retirement is Social Security. 69%. The AARP, the watchdogs, are saying that the maximum amount that a retiree can qualify for the Social Security system in 2023 is $3,070 per month if you're 70. $2,661 if you're at retirement age. $2,109 if you're at the age of 62 per month. And as we covered, Social Security is a very wobbly leg that can definitely, potentially crash down. But not only that, your 401k with your employer, your RRSP with your employer, or your defined contributions with your employer, that's invested. We're around the corner of a recession, and I'm afraid that it's even worse than what politicians are saying. There's so many bubbles right now, it's ridiculous. In every sector. Name a sector. I could be blind throwing a dart, boom, that sector is in a bubble. Very few have popped. Many will pop. Your best bet now is to invest in yourself. If you haven't, you're gonna have to learn from scratch. The bright side is, it's really bad and you can only go up from here. If you don't do anything while you have some time, you're going to have to learn the hard way, and I don't want to say that, but you're gonna have to take action. I know you've done the work. I know you've put in the hours to invest in the Social Security system. Trust me, there's so many people I see day to day that are thinking about this. And they've put in the work. They've raised the family. They're patriots. You always hear about stories about veterans, how this country has left them. I feel like we've done that as civilians, and the country has left us behind as well, right? Because of administrative greed and misallocation of management. So if you don't invest in yourself today with your retirement and learn how to manage your risk, but you're gonna have to take risk. I'm not saying all or none, balls deep. Excuse my language, I'm not saying that. But I'm saying you're going to have to, there's an opportunity around the corner. In a recession, in chaos, there is opportunity. You're gonna have to actually, this is not financial advice, okay? I'm not your personal advisor, even though I am a licensed financial advisor, but I don't know your risk tolerance. I don't know your profile. I don't know your age. I don't know anything like that. But this is what I'm gonna say. For me and the accounts I am in charge of, I have taken profits. Yes, there might be a little bit, more profit coming in 1 or 2 months. Who knows? I know you don't. I know I don't. I know managers are still estimating. But right now, we had a dead cat bounce according to my estimate, and we're going through a consolidation phase right now. So take some profits. Even if you think it's going to go up, take some profits. Have that liquidity in hand. Because when there's a huge recession, if the market fell by 50% right now, how much cash do you want to reinvest? Think of it like that. Out of your profile, if things drop by 50%, are you going to be okay? If you're not going to be okay, sell it today while things are not as bad as they will be. Hold that cash and re-enter in a year from now. Or enter when there's a huge drawdown. There will be. It's going to be bloody. It's going to be chaotic. It's going to be terrible. But you're going to want that liquid powder. You might want to sell furniture. You might want to sell some hobby interests that you may have collected over the years. You may want to start maybe picking up and creating a side hustle because you're going to want cash. This is once in a chance of a lifetime where this depression that's around the corner is going to create huge opportunities. And you're going to have to learn when the market drops and it consolidates for a while, you're going to have to learn how to generate additional income to stay afloat and to plan for your retirement. Make sure you like and subscribe because we're going to get right into that. Unfortunately, reports are also saying that in 2022, a lot of retirement accounts, 401ks, RSPs, ones that were investable assets, dropped by, on average, 26.5% as of 2022. And it is unbelievably stressful for people that have invested into their retirement to see their balance come down that much. The last thing you want to do is to be invested if it does get worse. You want that liquidity. You want to please take some profits. Please do, because that cash will come in handy when the market drops and you're able to buy things at a bargain. The Department of Labor has shared that only 49% of us have actually contributed last year in 2022 into our retirement accounts. 49%. And only 17% of us have actually a private retirement plan outside of that system. Only 17% of us. And only 49 have contributed into their retirement as of last year. These are very worrisome numbers. It is unbelievably stressful and difficult to be a senior in today's day and age. To make ends meet when bills are racking up and getting increasingly more expensive with your healthcare, with your roof and your shelter, with your food, with your utilities. If you're between the age of 55 and 64 and you have next to zero savings, you're going to have to consider working an additional 10 to 15 years, even up to 20, to have a decent retirement. This is the situation that we're in. A survey conducted by the Society of Human Resource Management has said that the population was surveyed and 40% of us believe there needs to be a financial miracle to help with our retirement. You know, the numbers are not looking good, but I don't want to share the specific percentages, but essentially, more than ever, all of us, whether we're thinking about retirement, investing in retirement, or it's around the corner, the biggest cost that we have to fight against is inflation. Inflation is the biggest and our worst enemy. So many of us, a large majority of us, actually had to draw down on our retirement savings. Accounts that we should not be expecting to withdraw from had to be accessed in order to meet both ends. We needed to draw them down. Americans, Canadians, and people around the world have to draw down. So many of us actually had to draw down on our retirement plans in order just to compensate for what inflation has done to our day-to-day life. If things continue the way they are today, more than ever, there's going to be an elderly wave into poverty. And that's around the corner. And our leaders are not even talking about this issue. It's a huge wave. They're just looking aside saying, hey, I don't know. They're not even talking about it. But this is one of the biggest challenges our countries are facing on the globe. And even though inflation is a huge contributor to why things are getting so difficult for all of us, it's actually not the main reason why retiring is so challenging. Around 1980s, The average median home was just shy of 76,000. It was like 75,000 and change. If we were to bring that up from the 1980s to today, 2023, the median home after inflation adjustment today is just a little bit above 70,000, just under 71,000 actually, 70,700-ish. The reason for that is because wages have not increased for the last 3 decades to the point just to maintain the median standard of a household. It hasn't. So I know inflation is the one, feels like we want to blame something, but it's actually our employers, where we go to work. Our wages have not been compensated as time has progressed in the last 30 years. This has costed us the most, more than inflation, in terms of our retirement plan. Many of us will go into poverty, unfortunately. A third of our population will get into poverty because of this lack of wage increases in the last 30 years. Due to a lot of the economic factors that are happening today, there is a huge wage gap and huge inequality between wage workers and what the markets have produced. And because of this, Generation X, Generation Y, Generation Z, and millennials are actually making less than their parents used to make for the exact same role in our society in terms of purchasing power. And this has created the inability for the next generation to just prop up the social security system for the next generation, even though the contributions might be there when they're not. Even though if the numbers were there and everyone contributed just as much as they did in the past in terms of percentage, it wouldn't be enough to keep that system afloat. So it's a very dire situation, ladies and gentlemen. And only you can save you today, because the people you had faith in was misplaced. And with today, right, my generation, the generations around me, we all went to colleges and universities. We paid these exorbitant amounts for our degrees. But when everyone has one and the market is saturated with these degrees, but we still have those student loans that are ever so high at a lower wage while we're trying to pay that off, it's going to be, like I said, people need a financial miracle to basically have a stabilized financial future. Because with student loans, with lower wages compared to our parents for the same sector, with a saturated job market, with everyone having a degree or diploma, it's not looking good for the elderly. This isn't looking too good. You know, the World Economic Forum has said that the United States specifically had a Social Security gap for retirement of about $30 trillion. 30 trillion. The IOU thing I was telling you about, 30 trillion, that's near the national debt. And that's only going to increase by 3 trillion a year. Yeah. You know, the retirement problem that I've outlined is a huge tsunami that is approaching us. And many of us are probably already feeling its effects as it approaches us. The monetary system, the fiscal policy, this retirement issue, the economic uncertainty, when this comes, this is going to leave so many elderly in poverty. And this is going to destroy and make our country in shambles as we're drowning in this situation. Because of monetary policy, that has devalued our currency. Now our purchasing power for our money purchases less. We now work more and receive less compensation. With that compensation, we have to pay for increased prices than ever before in our society. We're working more and we're receiving less. It feels like we're stuck in this perpetual nightmare, like we're on a hamster wheel just spinning, working more, getting less in this perpetual nightmare, and nothing can be done. We need to start waking up. We need to make sure that we hold ourselves, but specifically people that are managing our account, accountable. We can no longer give faith and credibility to institutions that have completely failed us. They tried their best. I'm sure they tried. I don't know if it's their best, But they certainly have tried. And now we see what happened when everything is mismanaged the way it was. We need to wake up and do better than our predecessors. How? I don't know. We're going to have to work more and receive less. But there is a way to look beyond this tragedy and to get better. You know, a lot of us have grown up in this society like with this consumer mindset. And this is the shambles that it has left us in. Always trying to keep up with the nicest newest cars, the bestest of this, the bestest of that. It's a very consumer-based society, right? You know, the poor people, when they make money, they think about how many the bills that they're going to be paying. You know, middle-class people think of what I can do with this in terms of the luxuries and lifestyles I can have. But the wealthy, we take our money and the only purpose it has is to make more money. So we need to help you shift your mindset. A lot of times, you guys, I've been completely thinking about a consumer-based economy. You're going to have to change your habits. You're going to have to live on a lesser budget to help your future in retirement because things are bleak, as we just covered. You know how bad it is. It's the mindset that you have been taught, you have been conditioned in, needs to change. Yes, you might have to pull back on a lot of expenses that you're normally accustomed to because you're going to have to find every single ounce of currency you can, not afford, you must, for your future, to invest, to make your money, make more money. All right, so if I were to come up with a plan for myself for the next 5 years, this is the process I would do to help myself go from zero to be able to retire, right? Or at least on the momentum of going to retire, right? Not assuming any unforeseen black swan events. It's going to be 5 asset classes that I'm going to be considering, right? The first one is stocks. I'm sure many of you have exposure to this. You guys probably already have a retirement savings account that's invested in your 401k or RRSP. You guys already understand what the stock market is. Historically, over the last 10 years, it's been doing so good, even though it's been going up and down, and right now we're in a bear market, let alone a recession bear market that I predict might be going around the corner. At the end of the day, if I were to tell myself this, not you, I'm not your financial advisor, but this is what I would do. Number 1 out of the 5 would be stocks. Now, there's different types of stocks. There's individual stocks, right? Like Tesla, Amazon, Facebook, all of these stuff, right? You can, but that's too much, right? A lot of you guys are not active traders. You guys don't know much about, a lot of the other stuff. I don't want to get into that. Don't worry about individual stocks. Think about more of ETFs or indices, right? Or mutual funds, as many of you guys already heard of. When you have an actively managed mutual fund in your retirement savings account, they give you a mutual fund, which is a conglomerate of different sectors and assets that they actively work, and there's a management expense ratio to help you trail those fees and commissions. So they take a little bit for you for your investment. Everyone's very familiar with mutual funds. But indexes and ETFs, if you were doing it yourself, might be a better way to help you save that little bit of difference, help you save that management expense ratio, because that does make a difference. So that's overall what a mutual fund is. You have a money manager actively managing the mutual fund, right? The assets in that mutual fund, that diversity. An index fund is the opposite. An index fund isn't a human that's actively trading and balancing that account, right? The mutual fund. This is an index fund where it's passively, right, being managed by an algorithm, by a computer, meaning the expense ratio, right, is a lot less because it's passive, and it's a computer, meaning you won't have to, have that trailing fee as much. Not only that, but indexes compared to mutual funds, for example, are not actively traded in a high volume in the market, right? On the Toronto Stock Exchange, on your S&P 500, they're not actively traded, so it's not volatile. Just generally speaking, on average, you're allowed to do it once. You're either allowed to buy or sell, and that's it. You can't keep entering and exiting, right? So index funds are really nice for that because they have a lower expense ratio because the computers are the ones who are balancing the account, right? And there's low volatility because you're allowed to enter and exit, generally speaking, once. Not only that, but they're attached to a certain index. For example, the S&P 500. You can buy an index that follows and trails that sector, right? That whole division. And if you do that, anytime, a company underperforms, it gets kicked out of that index and gets automatically placed with somebody that is waiting in line that deserves those credentials to be in this index fund. So it's passively traded by the algorithms to kick out underperformers, put in ones that are potentially will be performers, and it's passive, and there's low volatility because of the volume isn't allowed to be coming in and out of the sector. But not only that, indexes have, usually speaking, a qualified amount you're allowed to put in as a minimum buy-in. So you can have something as low as $35 minimum purchase to enter into to purchase an index, right? You can have a minimum buy of 500. You can have a minimum buy of 5,000 into an index. So that is a restriction that basically limits on how much an index can be purchased. And lastly, there's ETFs, electronic traded funds. ETFs are a little bit different than like mutual funds and indexes because unlike indexes and mutual funds, with ETFs, you're allowed to enter and exit the market several times a day, meaning you can purchase something in the day and sell it in the afternoon, purchase it again in the afternoon, and sell it in the evening before the markets close. So ETFs does have that higher volatility aspect to it, but similar to indexes and mutual funds, you can have passive and active managed ETFs. Now, when it comes to actively managed ETFs or actively managed mutual funds, Moody's estimates that about 75 of actively traded management accounts actually perform less than an index, right? Than like a S&P 500 or a Dow Jones or the NASDAQ, right? Compared to whatever it is that the sector they're in. And so Moody's has estimates that it underperforms most of the time, 75%, right? And so for me, not having an actively managed ETF or an actively managed mutual fund will help you not only save money because of my risk tolerance, but because of what my age is and how far I want to invest in, right? These are all assessments I would have to consider, just as you would have to consider yours, right? You're just not going to listen to a talking head on YouTube, right? Regarding your assets, your hard work, your blood, sweat, and tears for your paycheck and for your money. You need to risk assess yourself, see what's your time horizon, how much tolerance you can take in fluctuations and in volatility. When do you need access to that? An ETF is also really great because you can sell anytime you want, right? So that's what I like. I like ETFs because it helps me generate that. And there's so many different types of ETFs. I love cash flow. I love seeing that residual come in. It might have been because one of the guys I really focused reading and learning growing up was Robert Kiyosaki, and he focuses on cash flow, right? So I do love cash flow. I love cash flow. And you need to think about cash flow as well, because I'd rather have a bird in the hand than two in the bush. So what cash flow is when you're looking at an ETF or any other investment vehicle that you're investing into, it's essentially called, generally speaking, a dividend. And a dividend is this: when a company or an ETF is profitable, right? There's positive profits. It takes that cash and it says, what can we do with this profit? There's generally about three lanes of paths that it can go down under. One, it can save it as cash. During an emergency, during a rainy day, when there's an event comes, it holds the cash or cash equivalents and says, hey, we're going to be using this cash. Option number two, reinvest back into the company. Should we expand on this? Should we open up new storefronts? Should we manage that with this? Or should we look into research and developing that? Reinvesting back into the company would also include purchasing back some of that stock, right? Option number three is, hey, let's just reward the people that own our shares. Thank you for purchasing how many shares. We're going to give you a percentage for each value of our shares, and here's your money. Well done for showing faith with us. We're going to reward you for having what they call diamond hands, and here's a dividend. Dave Ramsey loves it. I don't blame him. Cash flow is king. So even though it sounds very nice to have that dividend, that cash flow, there are some things you need to consider before making that decision. Number one, when a company, instead of investing that to increase their capital share and they pay you that dividend, it's a taxable event. even though it's still in your retirement plan or your RSP or anything like that, even though it's still in your account, it generated income, right? Separately as a dividend, and that's a taxable event. Even if you reinvest it back in, it's still a taxable event. Now, in terms of taxes, consult your tax accountant, right? Your tax people. But for me, in my experience, and generally speaking, it's the lowest taxable capital gains there is. So it's a very favorable taxable event, especially when you compare it to your JOB, right? Compared to your employment income, right? So you save a lot of taxes, you prevent by paying a lot of taxes by having this sort of residual cash flow come in. So that's that profit. It actually saves you a lot more taxes than selling an appreciated capital stock or an appreciated ETF. So you have to do your own financial assessment to see how you are more tailored to what kind of strategy for your ETFs or your mutual funds or your indexes, right? The most conservative one, if you're retiring around the corner and you want to make sure that you don't have a lot of volatility in your investment, is considering, as I mentioned and alluded to, a conservative profile, right? A conservative ETF, a conservative style kind of mutual fund as well, right? This prevents volatility, and because of that lower risk, you get a lower return. But it's more of a wealth preservation rather than wealth generation strategy, right? You want to preserve the wealth you have. Above conservative, right, would be balanced, where you're middle age, you have a little bit of time, but not too much, you have some change, and you're okay to take a little bit of risk, but not too much. And because you can take a little bit of risk, you can get a bit more reward as well. So that balanced ETF or balanced mutual fund at your financial institution, once you talk to a financial advisor, they'll be able to put that together for you. Above the conservative and above the balance is growth, where you have a lot more time, right? You have time working on your side. You can take some money and you can take a little bit more risk, right? Whether it's a startup that wants to expand or technology, growth-oriented ones tend to be a little bit more, you're taking a little bit more risks, or you're gonna have a little bit more reward, especially if you have time on your side. Historically speaking, you're going to be doing okay. And above all of that, in terms of riskiness, but also rewardness, is aggressive. So it goes from conservative, balanced, growth to aggressive, generally speaking. Speak to your financial advisor in your institution or your wealth manager. But with aggressiveness, or aggressive portfolios, aggressive ETFs, you have time, right? Time is not an issue. You just want to make as much as you can. And you wanted it to be funded and balanced in terms of what's in my ETF is well managed, because it's according to an aggressive Toronto Stock Exchange or an aggressive S&P 500 ETF, where it's directly towards growth, a growth aggressive account, right? So you're able to have different tiers of mutual funds, indexes, and ETFs, depending on how much time you can have, how much risk you can tolerate. Do you have a family in mind? What's your short-term goals, right? So there are different versions as well. So make sure to find one that suits you best. So that's a general overview of how I would allocate to the first sector out of the 5 would be in stocks. And once you look at whether you want to do individual, which I don't think you should do if you don't know how to read business reports and profit and earnings and how much cash they're sitting on, all that work, right? If you want to be a little bit more broad spectrum, you can consider ETFs, indexes, and mutual funds. And once you decide that that's more for you, you're going to have to decide whether you're more suitable to having an actively managed account or a passively managed account. And then once you make that decision, what kind of account do you want? Do you want a cash flow generating one? Do you want a growth oriented generating one? Do you want one that's consumer staples, or what sector? There's so many different types that you're going to have to understand on what you want to do. Do you want tech? Do you want real estate? Do you want this or that or the next thing? Maybe there's an ETF or an index regarding that. Maybe you just want all of the S&P 500 or the Dow Jones or the NASDAQ, right? There are ETFs that can give you that exposure that also have a dividend, right? So this is not financial advice, but SPY is an ETF that gives you a dividend for that traces the S&P 500. DIA is the ticker for the Dow Jones, right? So it tracks the Dow Jones. That also gives you an dividend as well. Now, these do fluctuate over time, right? The dividend does, depending on the price and how much it produces. But generally speaking, it's very consistent and it generates about once every 3 months for you, right? In addition to that, there is also the QQQ. The QQQ tracks the NASDAQ as well, right? So there's different forms of ETFs that are active or passive that generate dividends or are more focused on capital appreciation. So you're gonna have to decide that for one. So that's a general overview of what I would do in the stock sector. All right, so investment sector number 2 that I want you to consider for your retirement plan is real estate. Real estate's really cool. I'm not talking about your primary residence. I'm not talking about investing something fixer-upper and flip it. I'm talking about generating cash flow. We're still on that topic because we're retired. If you're late stage retirement or if you're considering it, this is something you need to start changing your mind. From that consumer-based society we live in, you start wanting making your money to make money. That's how wealth is generated. You don't wake up and worry about going to work to pay bills. You're waking up and saying, I need to work so I can have my money make money. That's a mindset change you need to adopt. And if you already adopted that, you already know how beautiful rental income is. This is rental income where you purchase your first property, your 10th or whatever, and you're generating residual, monthly, predictable rental income. I'm not talking about purchasing a property and flipping it, right? That capital gains is speculation. It might go the other way. You might lose money because we might be entering in a recession. But because you know exactly how much this rental income will be month over month, you can definitely work in your finance. Now, I understand it's tough to have your first rental property if you don't have one yet, but you know what's not tough? Making friends. Find people you will be friends with and trust, and organize yourselves together, right? Have some credible people for that credit check and put your money together to generate rental property. If it's not you, find your siblings, find your best friends, find people you can trust in generating this rental property together if you can't afford it on your own. Generally speaking, when you purchase your rental property, you basically want to have an expectation of return. You understand whether the property goes up or down, you're making X amount per month. If you were to invest, say, let's say out of your pocket, $10,000, right? $10,000 you're paying, and how much can I expect per month, Basil, right? Or it's actually, sorry, per year, Basil. I'll say this, 7% is a great standard. If you put in $10,000 in a rental property income and you're expecting month over month in that year, you should be walking away with, what is it, 10,000, was that $700? $700 should be net profit in your pocket. This is after maintenance, this is after repairs, this is after any actively managing your rental property, right? It's a little bit more work, but it's worth it because year over year, you have some other place just as a backup to sell. If you need that cash, but you don't want to sell it because you're not speculating on the price, you're backing your hard-earned money to make more money. And rental income is a great way to do it. So some of the things you may want to also consider when determining what kind of rental property you're looking at is you do not want to overpay for your property. I know mega cities and metropolises, are so overvalued today to find property for, getting a mortgage on and renting it out. You do not want to over leverage yourself. You definitely do not. The last thing you want is to overpay for an overpriced property, right? Wait for things to cool down. Have some patience. Why? Because if you over leverage and you pay a premium for that residential unit so you can generate, rental income from it, guess what happens? You're paying higher for your mortgage. Especially with rates today, it's very high. It's very expensive to borrow money. Not only that, you have to pay property taxes. Property taxes is determined by how much you actually value that that property. So if your bank says, hey, it's going to be this much, that price is going to be based from your property tax calculations. Another third thing is insurance. You'll need insurance. And the more valuable your property is, the more you have to pay for insurance, right? So there's a lot of factors why you want to be patient and not overpay for a property. And that's why it's important to have a 7% figure in your mind while you're determining whether this property is a good property for rental income, or if you just should be more patient and wait for the next opportunity to come on your door to do another assessment. Now, I don't want to say that, having your first rental property is easy. Even if you have a bunch of friends together and you put that capital together, it takes a lot of work. But after that first learning curve hump, it's going to be challenging. You're going to have to be patient and work hard. You have to grind. But once you do that, once you learn how to appraise a property with a bank and work with residential real estate lawyers, right? And then work with underwriters and inspectors and doing your municipality and getting everything up to code and registering it and finding an agent to help you manage your property, and then finding a qualified tenant that is suitable, right? And then finding a contractor to put that all together. The learning curve is very much there. It's a new skill set you're developing. Invest in yourself. Grind, right? Put in hours in the day before you go to sleep or before you go to work. Invest in yourself. You're going to get through that tough one. It might not be easy in your first deal. It might not be easy for your first 3 deals, but eventually everything will be streamlined. And once you have enough experience, people will come up to you. Hey, Basil, you have experience in residential income properties. Can I work with you? I'll be like, hey, let me look at the deal. Yeah, I don't mind this. You gained my experience, but you brought me the deal. You have some capital. I'll pinch in a little bit. Boom. You see, you need to find people that know what they're doing, that have experience in this, and just ask them, do you mind if I jump on your next deal? I have some income. They'll be like, hey, you know what? We'll take your chunk, put it into my chunk. We have a bigger chunk. Let's look at some deals out there. We'll say no to a lot of properties because they're overvalued, but once you find that good deal in a nice area that that the markets are saying, hey, this is undervalued, needs a little fixer-upper, but it's definitely a rental property income potential place, that's a bagger. And then cash flow starts coming in. You hold that asset, roll over that profit to your second, your third, you learn some more, you'll fall down, but you'll get back up. You'll dust yourself off. Rental properties are not the easiest thing to learn off the bat. It's a lot easier to click and buy an ETF. I know, I understand that. But once you put in that work, it'll be, you'll have a sound peace of mind because you get to touch this place. You get to know this is a hard property, right? Yeah, you might not be able to take it with you to Tokyo or Cairo or any of these places around the world. It's stuck on soil. But there's very few places you can take abroad, right? But with residential income, you can create cash flow. And cash flow is king. Because when you're retired, you have a predictable amount. Hey, I'll be generating this much every year from my residential properties. I'll be generating this much every year from my dividends, right? So you can see how this will snowball, especially if you work together with people of the like mind that are thinking about changing their mindset from a consumer-based, paying bills, going on vacation and, enjoying the luxuries of life to grinding for a few years, investing in yourself. That way you postpone that gratification, making your money, make money. That way you in the future are better off than your cohorts, than your generation, than the percentile. You will be the difference for your family, your peace of mind, and you will inspire others because you'll see where you've come from and where you're heading. And when you're there, they'll come knocking on your door. I'm ready to learn, Sensei. And when they knock and you open the door, you're going to be ready. You're going to be ready to sit down with them and be like, hey, you're going to have to do this, this, and this. And guess what? Like dividends gives you a better tax break compared to, employment income. Real estate tax codes are incredible. They're amazing. They're so favorable. So you're going to benefit from a lower tax bracket once you understand the tax codes in your area. You're going to be like, oh my God, I wish I'd have done this before. And you're going to have a huge break because now your stocks are paying dividends and cash flow. Well, mine, right? Not your financial advisor, right? I'm going to have dividends that pay me, on a regular basis, a very consistent, predictable, calculated way. And not only that, I'm paying less taxes than employment income and other capital gains income. Number 2, residential income. Not only that, I get to pay less taxes. It's in my favor. That's a win-win. Grind to get this done, ladies and gentlemen. Trust me. Find people, learn the way, and invest in yourself. Because you are your own boss. You're in your own body. This is divine temple. with our spirit, with our breath. Invest in yourself, because you are going to thank yourself in the future because of what you do today, which will be your past then. And the third type of investment is actually business. So if you want to help fund your retirement or your investments, you may have to think of, hey, not only is there stocks or real estate, there's also businesses. Now, whether it's your own business or somebody else's business, that's up to you. Are you an entrepreneur? Ask yourself, will you start a business? Will you take some of the money that you have allocated for your investments away from stocks, away from real estate, and invest it into your company? Are you able to get a return from that? Or are you going to have to build the company slowly? These are questions you have to answer for yourself as well. Because if you don't have it already and you want to get it if you don't already have a business and you want to get the ball rolling, that'll take some capital, right? If you are not willing to put in the work and actively create a business from scratch or take over a business that you've purchased from somebody else that already has a playbook, then maybe the business isn't for you because you don't have as much time in your life, maybe family and job, or you want to spend time. Your priorities are just different. So sometimes having your own business might be too late. Or if you have time on your side, maybe you need to consider creating your own business. Because I'll tell you what, nobody ever got rich being an employee, right? You want to start your own business. You want to have your own assets that are like real estate or stocks, right? You want to make sure you're a business owner, whether it's a partial owner in a company like in stocks, or you're a business owner of a rental income property, or just a LLC or a trust or something that creates income for you as well in terms of business expenditures, right? So that's something you have to consider. You have to self-reflect and see, do you want to start a business or do you want to purchase a business and actively manage that? Maybe it's a laundromat business or brick and mortar. Maybe it's dry cleaning. Maybe it's ATMs at clubs and restaurants that you're doing. Maybe, there's so many different types of businesses out there that there's so much possibilities, right? The important thing about a business is you want to solve a problem. If you solve a problem, money will come. That's like tried and true throughout history. So maybe businesses are not for you, right? That's one thing you just have to consider in general. But if you were to purchase another business, right, you want to, generally speaking, right, not your financial advisor again, but startups are usually the place to go. Now, there is a lot of risk, right? Whether you start your own business or whether you purchase another company, right? Starting your own business, there's a lot of risk. It might go to zero, it might go bankrupt, belly up, all that time and money you have lost. But if you invest in a startup and you do your due diligence, you look at their plan and their proposal and what they're planning to do, you can make money, right? There's programs out there, there's websites out there, there's companies out there that help you connect to startup companies that are looking for capital, right? As an angel investor, you can do this. But in generally, when you do invest in these kind of companies, there's only a few ways for you to make money. Right? One, if it has a public listing, you have an initial public offering on the stock market, you make money because you go from private shares to public shares, right? You go from basically accredited investor or something like that to having a public share, so you get to redeem some of your shares. Another option, instead of going to IPO and having a public release, is if your company that you've invested in, your startup, gets acquired. If it gets acquired on a private side, you get paid out as well. So those are the two major ways to do it, but there is a lot of risk. It does take a lot of activity and a lot of due diligence, but the rewards could be exponential. It could outpace your, stocks and your real estate. But with more risk and reward comes more learning, comes more understanding. Depends how much time you have. So make sure you do your due diligence. Please do your due diligence if businesses are the right type of investment for you. So the number 4 form of investment that you may consider for your own retirement is cryptocurrency, but specifically Bitcoin. Why Bitcoin over other cryptocurrencies, you may ask? Because Bitcoin is the father, the mama, the initiator of the whole thing. And blockchain technology is only one piece of what makes Bitcoin so special. Blockchain technology is just a series of digitalized ledgers, right? Connected to one another, basically tracking its history. Now, what makes Bitcoin so special is because you have to use energy to keep the integrity of that blockchain sound and secure. If you don't spend that energy and you can willy-nilly just create blocks on the blockchain, that's basically the fiat system today that we have, right? If it has no max supply, Bitcoin has a max supply of 21 million. Meanwhile, like Ethereum and other Ripple and other cryptocurrencies don't have a max supply, meaning they can always be devalued by printing more of their cryptocurrency on their blockchain, right? So it's important to understand what makes money money. One is the scarcity. Bitcoin will forever have a maximum of 21 million. Two, its blockchain is proof of work, meaning you have to spend energy in real life and put it into this system to solve a puzzle. Now, once you do this, right, it'll generate Bitcoin. Now, what is the Bitcoin? The Bitcoin, think of it as an energy capacitor. It'll store that energy that you put in around the world to create that Bitcoin. So later in time, you can harness what you've saved in the past and spend it today at a higher price, ideally, but you can spend that energy because somebody's willing to give you cash for that at another location. So you can mine Bitcoin in Texas and spend it in Alaska, right? Very quickly sending that battery. Now, if you dilute the battery by creating more cryptocurrencies, it'll devalue the scarcity aspect of it. And that's essentially the problem we have today. People are working hard, clocking in, clocking out, getting cash, putting it under the mattress, putting it into their savings. And what is the government doing? Just printing more. If you just keep printing more, it's diluting what we've worked hard for. That's the problem with proof of stake, right? That's the problem of not having a max supply, right? So it's very important to understand Bitcoin compared to just the technology of blockchain, because blockchain, you can have CBDCs like the FedNow coin or the Canadian CBDC or the Nigerian CBDC, right? It's not so much about the technology, it's just the technology of script. But what makes it important is the amount of energy used to make that, because it creates a battery that stores that energy and you can send it somewhere else to use it. If you don't create that scarcity for that battery and you keep printing battery like we do with money, we exchange our time, our blood, and our sweat to generate an income. And if they just can willy-nilly just create that same money outside using a printing press, it devalues what's in our pocket by making it less scarce, by making it more abundant. Now, one true principle of money is scarcity. When your money is scarce, products and everything else become abundant. But when you have your money abundant and it's not scarce, everything else becomes more scarce, hence inflation. When you have a lot of cash, other things get more expensive. But when your money is expensive, everything else becomes abundant, right? That's why it's important to have a max supply. That's why it's important to have chain of custody on your blockchain that is based on proof of work, because not only will you be putting in this energy and storing it in the form of Bitcoin, with a max supply, you're also that form of energy that while you're putting it into proof of work, right? Even though it's less than, say, like all the Christmas lights we have in the US for 1 year, even though it's less than, our modems running and our routers and our dishwashers just being plugged in, not even used. It'll use less than that. So I know there's a lot of fear mongering regarding how much energy is being used. It's very inconsequential considering it's hard money. When we mine for Bitcoin, right? And Bitcoin is generated, that energy not only creates a scarcity level of energy capacitor, it also audits the entire blockchain, meaning from 2009 till today, the amount of energy that was used from then to today has to be matched and exceeded to rewrite that ledger because of proof of work. Now, if it's proof of stake and it's just willy-nilly, some guys went on and, oh, look, we have zero energy into our ledger. Guess what? Some centralized guys, some geeks would be able to rewrite the whole thing and just change your code. There's no security. Right? It's all centralized. It's all up to the federal government or the central bank or the directors and the CEOs of this administration and that foundation. You're going to leave it for human error and greed? No. You want to make sure you invest in the security, the scarcity of your money. You want a max supply. You want a system that audits itself every 10 minutes, whether you audit it at the bottom of the ocean or on the surface of the moon. It audits itself. You don't have to call a third party, hey, check our proof of stake system. No, proof of work. You want to make sure. Gold, the proof of work has already happened. A star combusted. All this pressure and minerals found each other and made this mineral. That's proof of work. Work that makes gold unrustable, malleable, brittle, fungible, right? That is the jewelry aspect, the metallic properties of gold, the intrinsic value of gold, because all this energy was put and saved into gold. That's why it's super valuable, because down the line, 5,000 years from now, it'll still not be rusted. You can still make jewelry. It's still a semiconductor, has these properties. Bitcoin, exact same thing. You put in the work to solve this puzzle, to generate a Bitcoin. Now it's on a secured layer, meaning you can transport it through time in the future. Your great-grandchildren will be able to inherit it and spend, because they realize you made that investment, and there's only a certain amount of Bitcoin that will ever be created on a unrewritable, it's a trustless system, because you don't need to rely on human error. It's already built into it. That's security. It's like the Great Wall of China's firewall, but even better than China, right? Which is amazing for security. Another reason is it audits itself every 10 minutes. Another reason is one Bitcoin in China is the same as in Canada, as is the same in New Zealand, is the same as South Africa, is the same as in Nigeria, is the same in Chile, it's the same in Fiji Islands, it's the same in Australia, it's the same in everywhere. One Bitcoin is one Bitcoin. Nobody can just print out of thin air. Not the Ethereum Foundation, not anyone else, not the central banks. You'll have to put in the work to reward it. If something was easy, everyone would do it. Bitcoin ain't easy. And so that's very crucial on why Bitcoin is important compared to cryptocurrencies. Cryptocurrencies just means it uses a blockchain, which is a system of communicating. Now there's different types of blockchain, there's all this, other that. But when we're talking about investment, we're talking about having something like a commodity, like gold, silver, and Bitcoin. Now, for me, that's not a large part of my portfolio. It can reach up to 20% of my portfolio. Right? So let's say I have 10% in Bitcoin, 10% in gold and silver, and I'll be good, right? So that's another one. Bitcoin, maybe a little bit of exposure into Ethereum or whatever, depending on your due diligence, right? Depending on how much you believe in the network effect and where this is all going, and you do some research. It's a little bit more gambling when you're looking at things that are proof of stake rather than proof of work. So I'm not going to tell you not to go to the casino and put it on red. You can do that if you want. I'm not that type of personality. I'm more of that conservative, smart, intelligent movement, right? So I understand that Bitcoin and its scarcity, proof of work, where you can use it as a capacitor to transfer energy from around the world, especially with the Lightning Network. The communication system is basically saving El Salvador right now, right? Which no one's talking about, especially the World Economic Forum. They hate El Salvador because they're going against the grain, and they're actually, during this volatile time, this recession, this bear market that we're in, El Salvador is booming. And you won't hear about that because they can't regulate Bitcoin, right? Well, they can't control Bitcoin. It's a commodity like gold and silver, right? So that's my number 4. Specifically Bitcoin, do your due diligence if you're gonna get into cryptocurrency, but understand majority of cryptocurrency that's not Bitcoin is a casino. So make sure you do your due diligence. Now, there are cryptocurrencies out there that are called stable coins that are backed by, are pegged to the US dollar, and that's huge. Places like Venezuela, Argentina, Nigeria, where the money, Turkey, all the other currencies are very volatile, very fluctuating. They can convert, into the US dollar, USDT, Tether, or USDC, some sort of stable coin that is pegged to the US dollar. That means they don't have to go to the bank and find US dollar and pay that premium. They can just go on their exchanges, have some US dollar that's pegged to the US dollar, the stable coin, and be able to interchange. We see a lot of countries doing this because their own currency is destabilizing. So we see that, stable cryptocurrencies are very popular, very common. I believe that's actually the number 1 threat that US Treasury was saying, that stable coins are basically taking their place, and that scarcity of the US dollar in the most remote regions of the planet is basically unbanking is basically banking the unbanked, right? And the U.S. government wants to make sure that they control every aspect of it, and people don't have that freedom to associate with whatever currency they have. And so that's something that there's always that ever-ending battle, but it's definitely changing a lot of places around the world. You let me know if your community is affected by that. So there is a huge importance and a huge revolution that's happening around the world regarding Bitcoin, stable coins, and other cryptocurrencies, especially when it comes to remittances. Paying somebody across the borders, not having to do a bank wire and costing you $15 or whatever. You can be paying fractions of a dollar, right? And it gets to them very quickly, within seconds, right? In many instances, if you're using the Lightning Network or stable network or anything like that, they'll get it very quickly. And this is revolutionizing the interplanetary payment system of the globe in terms of remittances. And this is game changing. This evolution happened outside of the bank, like Airbnb took place outside of hotels, like Uber took place outside of cabs. Bitcoin and the payments network system that it's giving birth to is happened outside of the bank. So make sure you do your own due diligence, but the researchers out there, go do a little bit of investigation, go do a little bit of research so you can be your own bank. And last but not least, this brings us to number 5, form of investment for your retirement, for your future, precious metals. Now, I love precious metals. It's what I got into before I got into Bitcoin and before I got into, real estate, after stocks, mind you, but huge. I love precious metal. What? Because it's a hedge. It's a hedge against the corruption that we find in central banking from fiat currencies taking away our purchasing power. In order to maintain our purchasing power, we find gold and silver to be the best way to preserve your wealth. Now, for me, up to 10%, meaning, it could be 5, could be 3, but up to 10% of my investments will be hedged against currencies in the form of gold and silver. Now, ever since the time that Richard Nixon basically nationalized the gold away from our, or closed the gold window from the world from redeeming their gold into currency, that has created everything to be valued in US dollars and unpegged from gold. Right? So they can keep printing currency, but it's hard to print gold. You can't. You have to actually put in the work, right? It's proof of work, not proof of stake. Oh, because I have stake in this company, I can generate dividends. That's amazing. I love dividends. Don't get me wrong, right? If you're an owner. But when it comes to global economic finances for your country, for your state, for your municipality, you want sound, hard money. You want to be able to transfer the work that was put in the past, right? Digging up, refining, putting it into a form of a coin, right? And transferring that value because effort was made across time and space. If you just keep having fiat coming out of nowhere, being printed out of a printer, and the people closest to the printer get the first benefit, the Cantillon effect, and you're waiting for that value to come trickle down on you, they just stole from everybody because they devalued the rarity of currency in everyone's accounts. But because they increase the supply and they're the closest ones to their printer, it's not a very sustainable form of money for the country. We've seen historically that kind of currency never lasts very well, right? You can just look at my last video to learn how devaluing over time your money is actually ruining your future, right? So that's why it's important to have gold and silver, because it hedges against all of this madness that's happening in our system, right? That everyone acquiesced to. By coercion, by deception, right? You have to put food on your table. You have to have a roof. So understand, we all have to do it under duress, under coercion, never having full disclosure on what's happening behind those closed doors. It's just the prison, the wall-less prison system that fiat is, right? So gold and silver helps me hedge against that system. Worst case scenario. Always good to have it. Stabilize your portfolio a little bit. It's not as volatile as well, and it's always nice to have and hold something, especially when you're watching like John Wick or a leprechaun always flicking a big coin. You're like, oh, why are they always doing that? They're showing you in your face that what you have in your hand is actual real money versus a banknote. A banknote in law, which is currency, is not money, right? You can look at Bouvier's Law Dictionary or Black's Law Dictionary and look up the word money. It'll say gold and silver or paper money. Now, we know that paper money is not an acceptable definition for money because it's a circular definition, right? You can't say, oh, money is paper money. It's a circular definition. So we know gold and silver preceded the word paper money in the law dictionaries, meaning paper, silver, paper, gold. That's a gold certificate, the greenback, what Abraham Lincoln wanted, what it was back then before 1861's coup d'etat that happened. Silver certificates and gold certificates are paper money. Later on in that definition, after it said gold and silver coins and paper money, it does not include banknotes. So the Federal Reserve note, the Bank of Canada notes, these are banknotes. They're legal tender, but it's not money. They are debt instruments. Debt instruments, technically in law, also is not money. They're currency, but not all currency is money, right? Currency just means a flow of exchange of energy. Now, if you're indebted energy exchange for another indebted energy, it's like a negative and a negative, right? But that's why gold and silver is super important, because it's actual real money. No matter what happens, it's a great hedge against the current system that we have, and we see that it'll only get worse in the future. So make sure you have some exposure to gold, specifically gold, but a little bit of silver can do you a little good too as well. So to review, right? Our retirement system is in complete shambles. Things are only going to get worse, so you have to invest in yourself. And the 5 forms of investing in yourself for a better, greater retirement, you may have to work with others. It's better to be cooperative together than compete, right? So make sure you find people of like-minded that you can study, grow together, learn from each other's mistakes, and bring each other back up. Our 5 forms of investments. First, you have stocks. I like ETFs. There's also indices and mutual funds. Number 2, real estate. Rather than residential real estate, think about income generating real estates as well. Number 3, businesses. Whether you invest in your own business or invest in another business, think about business if you have the time to actively manage this business. Number 4, Bitcoin and some other due diligence, do your research. I'm not your financial advisor, but do your research, whether to see if other cryptocurrencies are for you. Me, I love Bitcoin. I have a tiny bit of exposure in other cryptocurrencies, but Bitcoin is tried and true, and it's the most sound of all of them. Number 4, gold. Gold is amazing for you, tried and true throughout history. I love having it in my hand. I'm not talking about like the ETF, you can, but it's always better to have it in your hand. Yes, you'll pay a little premium, but that's the cost of having it, a real asset in your hand, and have a little bit of exposure into silver for your day-to-day smaller things if things get that bad. But again, it's an industrial metal, so make sure you have some exposure into gold. So those are the 5: stocks, real estate, business, cryptocurrency, specifically Bitcoin, and precious metals, specifically gold as well. If you made it this far, let me know your thoughts down below. Make sure to leave a comment. If you liked, hit that like button. I would very much appreciate it. This took a lot of work to put together. And if you haven't subscribed yet, make sure to subscribe to get great educational financial content. We're increasing our literacy together. We're going to make sure to share with you the best insights that we come across over here at the Financial Almanac. I'm your host, Basil. Thank you for watching. Till next time, guys. Bye-bye.